interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody, and welcome back to the Raw Selection Private Equity Podcast. Joining us today is Bryan Gordon, founder and chief executive officer of Madison Ventures Plus, a boutique private equity and venture firm based out of Florida. Welcome, Bryan, and thank you very much for sharing your insights.
Thank you for having me, Alex. Nice to be here.
Absolutely brilliant. So as is customary, Bryan, if you could give us a 60 to 90-second breakdown of you, please.
Sure. Was educated in business at the Wharton School of the University of Pennsylvania, undergraduate, and then got my MBA at Columbia Business School and headed into the world of risk management consulting thereafter, where I spent 3 years focusing on how to protect against risk, which has very much informed my investment philosophy for the rest of my career. Then I went to Wall Street and worked for about a decade in corporate finance and investment banking at Smith Barney and Bear Stearns, mostly focused on real estate, healthcare, and other old economy asset-based industries. And then in 1996, I departed and opened my own boutique investment firm called Madison, which I'm still heading today, 27 years later. Madison has invested in a wide variety of different off-the-run financial securities and financial instruments, assets and asset pools, and companies, mid-market companies and platforms with the focus on trying to find structural arbitrage opportunities that are long-lived and that present an opportunity for an asymmetric reward versus risk profile. So that's us and me.
Thank you very much for that. So what's one mistake that you see either private equity firms or portfolio companies making, and what actions would you suggest to correct them?
I suppose I see more than just one mistake, but perhaps the most significant mistake that I see investors making is a focus on the upside first, as opposed to focusing on the downside first. And I think that's very much embedded in the structure of the private equity and venture investing industries. And, from a fiduciary point of view, I think your first job to your investors is to preserve their capital, and anything that comes after that is all good. And so we take the approach of trying to make sure that capital will be defended through cost basis, through structure, through fundamental research and valuation and due diligence, and then let the upside take care of itself. And I think that, the industry, particularly with the fact that few investors typically have their own personal wealth or skin in the game and are, compensated by virtue of typically scaling assets and making profits above some kind of a hurdle that incentivizes people to swing for the fences as opposed to defend the downside. And, lots of great ball players got into the Hall of Fame by hitting singles and doubles and not worrying about playing baseball like Babe Ruth.
Very good advice. Appreciate that. So why do you think that the team element is so important when looking and completing an investment?
Well, team is really people are really the core asset in most businesses today. Long gone are the days where machinery or other kinds of tangible assets, really create value, like in the days of Henry Ford. And so it's really all about team, intellectual capital, and execution. I think ideas matter. Creative ideas make a difference, but 90% I would gauge of real value is created by excellent execution. And that's, all about a leader or a small group of leaders, and then a lot of teammates banding together with a cohesive vision, a cohesive passion, and really rowing the boat in the same direction. And that's not easily achieved. But I think that most value is created by that sort of operational excellence. And that, of course, all stems from, the entrepreneurs who you invest with and or the, institutional operating partners that, you bring in to lead and build these enterprises alongside those entrepreneurs.
Perfect. And based on that, what do you think makes a top executive, a really great member of that leadership team? What's your kind of take on, whether it be three things you look for in those execs, or what's kind of your criteria to know if you're investing in good people as well as a good business?
I think the most important attribute of a top performer is willfulness, especially in the face of bucking conventional wisdom. My take is that conventional wisdom typically isn't wise, it's just conventional. And that most really good ideas and innovative ideas are bucking some kind of a trend, and you will have lots of doubting Thomases and lots of dark days, implementing your vision and your idea. And that willfulness and stick-to-itiveness and belief that this is really something that is possible is perhaps the most critical attribute of a truly, top performer. Ironically, the second attribute I would ascribe to top performance is open-mindedness and a receptivity to opinions and ideas that come from anywhere, from, the person working in the mailroom, all the way to your closest partners, and from people and industries that frankly may not seem to have any direct relevance to a particular investment, but there's, a tremendous amount of ideation and, wisdom that can come from keeping an open mind and open eyes and looking around. And that seems at odds with willfulness, but I dare say the best people are actually both. Thirdly, I think passion is just critical. It's really hard to be great at something that you're not in love with. And so I think that whether that's being a chef or a musician or chief operating officer or what have you, or an accountant, it's crucial for you to follow your heart, and generally the best results will follow from that. I'd certainly give a big assist to work ethic. I think that grittiness and hard work do matter. And lastly, I'd add that I think it's really important that you orient your teams and try and, recruit people and surround yourself with people that think like an owner, which I find really make the difference in terms of top performance, not only for those people, but for the enterprise that they're serving.
You've obviously grown Madison Ventures and led that and established that business a long time ago. I'm sure you've seen many private equity firms come and go, and no doubt many portfolio companies do the same. What advice would you share with other private equity investors who are growing their private equity firms to kind of stick around for that longevity game and not be that kind of flash in the pan type scenario, which I'm sure you've seen a few times?
Yeah, indeed I have. I think that the first thing that I would offer is that it's better to be a mile deep and an inch wide than the opposite. I find that a lot of people in the private equity and venture space tend to be overly generalized. And while I do believe that good investors and good business executives can operate across borders, I think that some degree of focus is beneficial in terms of everything from execution to deal sourcing to network building on the operating executive side, sourcing capital, et cetera, et cetera. And so I think some degree of focus is beneficial. Secondly, as we talked about earlier in the show, a real focus on hands-on operational expertise and, kind of rolling up your sleeves and getting your hands dirty, and a willingness and an ability to do that, I think matters. I see too many firms in the investment space who focus on ideas and who focus on, financial planning and financial engineering. And while I do believe that all of that matters and all of that can build value, as I said before, the best laid plans can go awry without an execution. I think that planning for risk management is very critical, including black swan events. Black swans are far more common than commonly believed. And, they're very difficult to control for, as we're seeing at present, with a lot of surprise occurring in the banking sector, a lot of surprise as a knock-on effect occurring in the venture capital industry broadly. And so, really thinking about what can happen more than one or two standard deviations from the norm, I think is an exercise that's very fruitful. I'd also mention that I think that the industry typically has a full sense of comfort by virtue of control over major decisions. And I'd argue that while major decision control is indeed important and beneficial from a private equity or venture investing perspective, that it's insufficient in and of itself. And the real control comes from having your finger on the real heartbeat of the business from a data and from an operational lever point of view. And it's hard to do that sitting in a board seat far away from the company and, meeting once a month or once a quarter. Really difficult to have true control over your outcome.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. When I was looking through the research and your background of the firm, you've got some pretty impressive returns. We've got, 25% plus, and I think that's a conservative figure. What are you guys doing that's producing that levels of returns kind of year on year?
I think, first of all, we are focusing on, as I said earlier, structural arbitrage opportunities. So opportunities, where there is some kind of an asymmetry between us and the market, which may be created by information. It may be created by embracing operational pain and challenge. It may be by embracing legal or regulatory complexity, by embracing distress or bankruptcy, or, a whole variety of circumstances. But, some combination of those factors creates an opportunity to create value on the buy. And you're just way ahead of the game when you can buy something that's worth 100 for less than 100, and ideally significantly less than 100. And so that's the first thing that, creates value for us. Secondly, we tend to focus on not one-off opportunities, but rather repeatable opportunities where the opportunity will be repeatable over a period of years, as opposed to, a few times. And so that we can get extremely good and develop, all of the operational expertise and due diligence expertise and the network effect and so on and so forth of that niche opportunity, and really mine that opportunity systematically over a period of time. And then, just lots of elbow grease to take that advantage that you hopefully acquire on the buy, and then actually add a beekeeping dollop of growth on top of that. And as we've talked about, I think execution is the key to that. So those are the, relatively simple philosophies that have guided me and us from an investment point of view since I started Madison 27 years ago, and have, resulted in a pretty, steady asymmetry between reward and preservation of capital.
Excellent. Very impressive returns there as well. What do you love about the private equity industry, and equally, what do you dislike about it?
I love a lot about it. I've been doing this a long time, and it's as much a passion project or avocation as it is a vocation. Probably the first thing that I love most about it is working with passionate and creative entrepreneurs who have great ideas and great vision and great knowledge in, various nooks and crannies, and, meeting and helping to tease out the ones that really have something that is scalable, and then working with them to scale it in an institutionally robust fashion is really fun and gratifying. It's a combination of a treasure hunt and, mentoring and a lot of other fun things. So that's probably the thing I love most. typically we invest in places where other institutional investors are ignoring opportunities. So, we're investing in white space where few choose to tread. And so that in and of itself is an adventurous. I guess I tend to be, contrarian by nature and, like to go off the beaten path by nature. So it's fun to have an outlet to do that. Obviously, we are investing in a lot of different companies, securities, et cetera, over time. And so there's, something new always. And learning is, I think, for most people who are in this field and especially good in this field, is something that, is a passion for us. And so that, constant learning curve and diversity is tremendously rewarding. Things move quickly in this world, which I think is fun. You get to see change, visible results relatively quickly, for better or for worse. You don't need to sit and watch the grass grow to effectuate change. And for somebody with my personality, at least, that's a great deal of fun. And lastly, maybe I'd call out that it's very much a team sport as opposed to an individual sport, and getting a group of people to come together, share a vision, share a passion, and row in the same direction, to me, is much more gratifying than, being a lone wolf or an individual contributor. So those are the things I loved about it. The things I dislike about the industry, I think that there can be, in some people in quarters, an arrogance and an overconfidence because they, sit in the chair of doling out money and having control over companies. And I think that's typically ill-founded, and in any event, not a good look and not a good way to, inspire the constituents that you are collaborating with and that you are serving. As I talked about before, I think that there's a misalignment that has been created by compensation structures in the industry, particularly by the fund model, and it causes investors to put capital out, quickly. It causes investors to, focus on hitting home runs when sometimes a single or double would be far more prudent. And so I don't care for and subscribe to those traditional models about how to pursue the industry. We've chosen to be a fundless sponsor starting back in 2010, after having been in the fund business and the managed account business for about 15 years before that. And I've found that the fundless sponsor model is really a better model to align interests between investors, entrepreneurs, and the PE or venture shop. And so like that model a lot. And then the last thing that I dislike, as I referred to earlier, is, the general lack of willingness for people to roll up their sleeves and get their hands dirty operationally. I think, the model of sitting on Mount Olympus is not the best way to control risk and to create value ultimately. Sometimes climbing Mount Olympus on a regular basis is important so that you get above the tree line, so to speak, and can see the big picture. But then I think you need to get back down with your boots on the ground.
It's interesting you went back from going or seeing back, obviously we're a fund-based firm and then went to deal by deal type process. Did that come with many complications? Was that a simple shift to do? Because most firms go the other way.
Yeah. It wasn't complicated and it was relatively simple. And I found it to be a great decision. It's now a more than a decade-old decision. And we did it before the term fundless sponsor was even a term. I mean, we had confidence in our ability to source deals, regardless of not having committed capital sitting on the sidelines. In the nearly 30 years that I've been doing this, I've never not been able to fund a deal that I wanted to do. So, and that, was a testament to good track record and good relationships and the stable of people who trust and like what we're doing. And frankly, it empowered them to be able to choose what deal they wanted to invest in and what deal they want to, pass on for whatever reason, and took the whole black box of the fund model away and gave our investors, who are really our, ultimate constituency, more power in the form of disclosure and transparency. So it's been great. And what it did for us was it gave us the ability to not commingle deals from a performance point of view. Each deal stands on its own. Each deal can be constructed within its SPV with a capital structure and a business plan and an investment time horizon that's, unique and bespoke to the business and makes sense for that particular business, as opposed to, trying to jam a business into a fund structure where the fund structure dictates the business plan as opposed to vice versa. So no, it was seamless for us and I've never looked back and don't think I will be anytime soon.
Makes sense. So your influences, what do you read, what do you watch, what do you listen to that you would recommend that others check out?
Yeah, I'd say the first thing that I read a lot about and that I would counsel everybody that wants to be a good investor about is history. Most of what, we experience in the world and as the human condition has already happened countless times before. And you kind of have an unfair advantage if you have seen the movie and you know how the ending goes. And that's all contained in the history books. So I am a pretty fond student of history, particularly Western history. And so read a lot about that. I, of course, as you might have guessed by talking about creating value on the buy, inherently at heart, a value investor. And so the great value investors like Graham and Dodd and more recently, the Seth Klarmans and Howard Marks and Warren Buffett's are all big influences on me. I certainly think that in order to be a good investor, one needs to be a voracious reader and stay abreast of current events, both business and otherwise. So publications like the Wall Street Journal and the Financial Times are daily reads. But I also think that being a student of culture and the zeitgeist is critical, as well as, it stokes your, sense of creativity, of innovation and what is possible. So I see lots of art, take in lots of films and TV, listen to lots of music, all of which, stimulates the creative side and keeps me closely in tune, I hope, with, what is coming tomorrow as opposed to what happened yesterday. Both are critical perspectives to being a good investor. Few of my favorite books: The Rise and Fall of the Great Powers by Paul Kennedy, The Art of War by Sun Tzu, Seth Klarman's Margin of Safety, and last but not least, let's call out Harold and the Purple Crayon by Crockett Johnson.
Those recommendations, a few new things there for me to check out as well. If anybody wishes to reach out to you, Bryan, post this podcast, how best do they get in touch with you?
Yeah, they can email me at bgordon@madisonventuresplus.com. And of course, visit our website at www.madisonventuresplus.com.
It's all in the show notes. Well, Bryan, thank you very much for joining us. Really appreciate your insight. Leave us lots of value in different perspectives, private equity professionals and portfolio executives. So thank you very much for coming on the podcast.
Thank you for having me. Nice to talk to you, Alex. I appreciate it.
You too. And as always, thank you very much for those joining us. And of course, should you ever need any support with private equity professionals or portfolio executive hiring across Europe and North America, please do reach out to us at Raw Selection. And if you have not already, please do subscribe to the podcast and you'll be notified of the next podcast that comes out every 2 weeks. Until the next time, keep smashing it. And thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.